Hello guys, I hope you all are doing well. In today's quick video, I wanted to discuss one particular bearish strategy that you can use to make some profit in this environment. As we are seeing, the environment that we have right now is kind of, at least in the near term, it seems to be little on the bearish side. So I wanted to show this strategy so you can make some profit out of it. So for today's strategy, I'm going to use Apple, as this is kind of has broken the support that it had, and it is seems like it is going in a downtrend moment right now. So I'm going to use Apple as an example. So if you go to Apple's option chain, right, what you need to do is you basically say buy a call. First you have to select the expiration date, right? So I'm going to select I'm going like 30 to 45 days, which is ideal for any option strategy that you do. So I'm just going to go and select November 3rd, which is almost 40 days apart, right? Between 30 to 45 days, right? So, and here what you do is the first thing, as you are bearish on Apple and you expect the main strategy is like you expect the Apple to go down. So you buy a call at say 170, right? That is your max price that you expect Apple to end below on a below 170 at your expiration, right? So that is the thesis behind this strategy. And then what you do is you sell a call right below that, right? So this by itself, right, as it says, the call credit spread, right? This is one of the popular bearish strategies that you would have heard of, and you might have used as well, right? So this is one of the popular strategy. So as you see from the profit and loss for this, right, your max credit here is 330. However, there are two things that I don't like about this. One thing is your max profit, which is like this credit that you get, right, that is getting capped, right? So even if Apple drops below 165, you are not going to get more than this profit. So there's your max profit is kind of capped here. The second thing is the risk to reward ratio, right? That is also poor in this, because your max profit is capped, and your overall the loss, right, that if you consider the loss and the profit, the ratio is not good in this. So how do I improve that? That's where one tweak to this particular strategy comes in. It's like you are going to buy a put. You just add one extra leg to this. You buy a put at 165 itself, right? Same expiration, everything remains same. You just adding a put. So what? So as you know, right, when you buy a put, you pay money to get into that contract, right? But since you already received some premium, right, buying a put, you're kind of I'm paying for that put from that credit itself. So overall, your net credit is still, you are getting some credit out of this. However, see this here, right? Now look at this profit and loss, right? What happened to the profit and loss chart? So now your profit potential is almost unlimited, right? You're getting a profit of more than 16,000, right? So you're basically opening up your profit on the upside. So now it is no more capped. Now if you look at the risk to reward ratio, right, that is also pretty good in this case. You're only risking this much, but your max profit is good. The thesis only is you are bearish on that particular stock, right? So that is the main thesis behind this strategy. Okay, let's also look at this visually, right? I always like to see the actual numbers in the option strat to see how it looks at the profit loss looks at each point in the future, right? So for that, a very good site that you can use is the option strat. In this one, let's build the same strategy that we built, right? So it was a bear call spread, and what we did was we did bought a call 170, we sold 165, right? So this was the original one. So if I reduce this little bit. So as you can see here, right, clearly whatever Apple drops beyond this point, your profit is going to be capped at this 345, right? That's your net credit. Even if the Apple drops to 150, 152, your max profit is gonna be capped here, right? So now what we did was we added a leg, right? So we added a put at 165, right? So now see how this changed, right? So now your max profit is no more capped, and as Apple drops below 150, 146, you are going to get profit of these numbers, right? And you can see at each point, you don't have to hold this option position for till the expiration, right? You can close it even like anytime in future, right? So let's say there is some drastic news comes in and the Apple drops to 150 by this September, or sorry, October 11th, right? So you are going to get profit this much, right? So you can very well close the complete position that we opened. So that is the beauty of this. You don't have to hold it, you can close it at any time. So yeah guys, this is what I wanted to discuss. So this I just showed in Apple as one example, but if you are bearish on any stock in near term, at least in next month or so, then you can apply the similar strategy. It is pretty similar to the call credit spread, with just one extra leg that you are basically adding here to compensate your or to increase your profit potential, right? And you are not paying it to open that put, you are not paying it out of your pocket. You are just paying that amount from the amount that you received. So that was it. I hope you liked the video. Please do like and subscribe for any future videos, and I'll talk to you in my next video. Happy investing guys. Bye bye.